Hey everybody, it's Seth and Uncle Paul for the Everything Money channel. Thanks for jumping in and following us. We love you if you're watching, and we're here to talk about Palantir. It's a big talking point on YouTube. If you're new or old to investing, you may be wondering why there's so much chit-chat about this company. And obviously, we wanted to see Paul's take on why this company has so much chatter and what's going on. Paul has done some extensive research on this company, and we're here to bring you what's going on with Palantir. They had a demo day. They are introducing some new products, and their inaugural demo day. And we're going to look at the company as a whole, perhaps using our 8-pillar analysis to see how it matches up. What is the financial health of this company, and what are we really looking at? And we hope you learn a lot of things here. Paul, what's going on with you, brother? What's going on with this company?
All right, so Palantir, I believe, was started by one of my favorite people out there, Peter Thiel. Peter Thiel, I don't know how you pronounce the name. He is a billionaire. He's a libertarian. He's a chess player. He was actually 1 point away from becoming a chess master and didn't get it. 21.99, I think if you look it up, is his chess rating. Now, this company is getting a lot of hype, and here is why. Look at this chart. This is a one-year chart. This is $9 a share just in October, and now it's at $34 a share.
This looks like a buy. This looks like a buy already, Paul. We should be buying this stock, I assume,
and
right?
that's what every YouTube person out there, personality, is saying. 10 extra money, it's already been up, this thing's going to the moon, great. What we're doing here, though, we're trying to figure out, does it justify the price? If it doesn't justify the price, what needs to happen to justify the current valuation? That is what we do on this channel versus all the other hype channels who have no idea what they're talking about, right?
Not all, but some.
Okay. Here are the things I want to focus on here for Palantir to start.
Go ahead.
$65 billion market cap. One of the things I'm going to start doing is showing you guys what other companies you can buy at $65 billion compared to this one. Because people see the chart, they think it's going to the moon, and that's all that matters. Okay, I want you guys to keep in mind.
Pillar number one is PE ratio, Paul.
It has no earnings.
Uh-oh.
So here's the deal. The numbers are so messed up that my YCharts account doesn't even have the right numbers on there. So we went to Yahoo, very simple. We're not gonna do this different from the
our usual analysis?
Yeah, because I don't have all the data here.
Okay.
In 2018, it did $595 million in revenue. 2019, $742. Nice increase, right?
Yes, very much.
In the last 12 months, they've almost done $1 billion. Very, very big revenue increases. Right?
Consistent growth.
Awesome.
Nice.
We love that. That's why it's getting so much hype. Yeah! Now, let's go look at the profit. Net income to common stock, the net income right here. They lost 580. They lost 580. They lost $1.2 billion almost.
Okay, it's puzzling.
So they're actually losing more money than they're bringing in revenue every single year. They're spending a lot of money on growth or whatever. Guys, this is a $65 billion company.
Yes.
$65 billion company that's lost $1.2 billion and only has $1 billion in revenue.
But for some reason, Paul, the comments below will be, you're wrong, this is a growth company, and you're an idiot.
Now remember, thinking about growth, guys. I believe that growth is a measure of, is involved in the value proposition. We're gonna draw our example here. Let's say you have a company that generates $1 a year for 5 years in profit. How much would you pay for it? You're gonna get $5 in profit over the next 5 years. Would you pay $5?
Nah.
No. Why would you pay $5 to get $5 the next 5 years?
Bad investment.
Yeah. Would you pay $4? Okay, it's not great. It's not terrible. You're gonna make 25% over the next 5 years, around 4.5% a year. Would you pay $3? 3 becomes 5. It's a 66% increase over 5 years. Okay, 12% a year. Not bad. Would you pay $2? I think you're paying somewhere around this range. So a flat company, you're still going to find a price that works for you. Now, what if that same company, what if it that starts with $1, then does 2, then does 3, then does 4, then does 5? Massively growing company. Profit's going to go up 400%. And for those of you who don't know, this is 400% and not 500%. From 1 to 5, $15 in total profit next 5 years. Would you now pay 5? Absolutely you would. You'd absolutely pay $5 to get 15 over the next 5 years. Would you pay 6? Probably. 7. So here's the deal, guys. For all of you out there who say I don't understand what growth is, this is exactly what's understanding growth. I was willing to pay 3 for this, but because of growth, I'm willing to pay probably $7, maybe $8. I'm willing to pay over double because of the growth. Growth is a factor in value investing. The difference is a lot of people will tell you that growth is the only thing that matters, and therefore you should pay whatever it takes. You might sit there and say, no, I'm not going to pay whatever it takes. But that's what you're doing when you don't care about the financials. That's what you're doing when you sit there and say, I'm going to pay $65 billion for a company that generates $1 billion in revenue and loses $1.2 billion in profit every single year. Or is doing that. As it grows, it's losing more money too. So let's go backwards and say, okay, let's say a company is worth $65 billion. What should we expect it to make? Well, historically, guys, a company that's worth $65 billion is what's going to have what PE, Seth?
65 billion?
What's the average PE over time?
20.
No, the average PE is about 15.
Okay.
But if it's growing, let's say we're willing to pay 20 times. So it needs to generate let's call it $3 billion in profit every year, just to be safe, just to be easy. $3 billion in profit. Now, this company, a software business, should be able to generate 20 to 30% in bottom line profit after all their expenses and everything, right? Let's call it 25%. So if $3 billion is going to equal 25% of their revenue, because that's their profit, because remember, revenue times profit margin equals profit. So we know that profit margin is about 25%, and the profit needs to be $3 billion. So do the math. 3 divided by 0.25, it needs to do $12 billion in revenue. It needs to do $12 billion in revenue to justify the current market cap. It currently does $1 billion. Is it possible to get to 12? Absolutely. I'm a huge fan of Peter Thiel. He'll probably get it there. He did PayPal. He's a genius. But here's the difference. When it doubles in revenue next year, what's everybody going to say? Oh, it shouldn't be a $65 billion company now. It should be a $100 billion company now. Now, this needs to be a lot higher. So that's the problem with growth companies. As it grows, you are paying the $12 billion revenue number at $1 billion. It's like Tiger Woods. It's like me and Tiger Woods. Tiger Woods hasn't won the majors. And Jack Nicklaus once said before his big scandal, can we let him hit 18 majors before we actually give him the title of the most majors ever? I think I'm going to be a billionaire someday. I'm pretty much confident in it. But I don't spend like a billionaire. I don't tell people call me a billionaire. Why? I haven't achieved it yet. Before we give them the $65 billion value, let's let them get there. The biggest example I get and the most compliments I get is baseball players. Any athlete. You go to a high school, there's tons of great athletes. Are you going to go pay that kid on a shortstop Derek Jeter money because he could be the next Derek Jeter? Let him become Derek Jeter first. Let this $65 billion company generate $12 billion in revenue and generate $3 billion in profit before you give it a $65 billion valuation. All you're doing now is you're looking at it from the perspective of it's growing, therefore it'll get there because the stock price is looking at it. That's not what we do on this channel. We look at the long term on any stock is what's behind the company. What's the revenue? What's the profit?
I think maybe, Paul, the idea that you're saying is a very patient and diligent approach that may take a lot of time, whereas it's so much more easier to just jump on a hype stock and maybe make a little bit of money. That's so much more.
And it's so much more expensive too.
Yeah?
Let's bring up our example of Amazon back in the day. Amazon is the one company that I can remember from the dot-com bust that actually ended up doing way better. The one company. And look at what happened with it. We're going to go back to Amazon. This chart looks pretty awesome, right? Look at this. It's going from pretty much a straight line up, right?
Boom.
This looks amazing, right? What do you see here, guys? You see anything here?
No.
This doesn't look bad, does it? Small fall, right? 2000, very small fall. All right, let's go look at that area of 2000. Let's go look what happened in that time range between 01, let's go to 01, January 1st, 1997 to 12/31/2004. Let's see what happened in that time frame. This is the actual chart blown up now, guys. 107, 6. This company went from $107 a share down to 6. This is the one company that I know of that made it over their peak from back then that was hyped up like this, and it still fell 94%. It still fell 94%. If you think you're the person that was going to ride this thing from here to here and back down to here, you are absolutely mistaken. Everybody thinks they're going to be the first one to exit the room when there's a fire. And then what ends up happening? There's a rush to the room, and this is what this rush is. That's all I'm trying to sit there and say. Amazon is the only one I can remember that actually, Cisco hasn't beaten its high yet. Intel has not beaten its high yet. All these companies, Microsoft has beaten its high, but Microsoft was way better than Amazon in terms of financials. It was making way more money, generating way more revenue. It was a more established company. So even before if you have a $3,100 stock, it had to go to $6. And you're going to be like, well, yeah, but look, it happened. Great. That's like making your entire life based on your kid becoming Derek Jeter. You're going to become Derek Jeter. You got that? How's that going to work? I teach slow and steady. Warren Buffett, Howard Marks, Seth Klarman, Ben Graham, Charlie Munger. These guys all beat the markets over 50, 60 years' time by doing slow and steady and being conservative. Mm-hmm. Unfortunately, paying for Palantir is too much. However, there are pluses and minuses for Palantir, but you just got to be cautious. It's not saying that at this price, it's not saying that you shouldn't buy Palantir, it's at what price you buy for growth. Just like we said, the examples of $1 a year for 5 years and $1, $2, $3, $4, $5 a year in price. There's a good price and a bad price to pay for it. Palantir at this price is just, does that mean it won't go to 100 billion? Absolutely. It could go to 100 billion, could go to 300, 500. I have no idea. All I know is if you have 100 Palantirs, you're going to lose a lot of money. Even if a few of them work out, you're going to lose a lot of money overall.
If this idea resonates with you, you can join our Patreon. You can get access to myself, our trader Mo, our day trader, and Paul. Get access to our portfolios and the community that we're building. We just hit 500 patrons, Paul. It's absolutely incredible. Our subscriber count is growing like bonkers crazy, and it's because of your support. And I would say that the like-minded people that we're attracting, Paul, do not fall for these clickbaity 30x style videos, and you've been against these for a long time. The Weeble trading, the Robinhood trading, all the BS that goes into making this sort of a game. You like a careful, more calculated, disciplined steps to investing. And really, in essence, is that people like myself, normal folks, are trying to teach you. I don't need to invest in Palantir, try and make some free scrap. I can just play that solid game of investing in ETFs, the boring game. So if you want to be bored with us and make money, come join us in our Patreon. Paul, that's your take on Palantir.
That's my take.
Thanks for joining us, guys. As always, make sure you tickle that thumbs up, subscribe, and we'll see you on Patreon. Thanks, guys.